This conference will now be recorded.
Thank you for joining me. My name is Steve Tuttle, and I'm the Chief Investment Strategist and a partner at Signet Financial Management. We're going to discuss and review the financial markets and our outlook looking into the coming years. I want to start by congratulating all of our clients who were able to stay invested in 2019. It certainly paid off in terms of attractive returns for investors. And I say this because there were certainly a large number of red flags and concerns that were prominent throughout the year. These included on the yield curve, bonds in Europe were yielding negative interest rates. Here in the U.S., there was a lot of discussion about how the yield curve was inverted, and this being a sign of a slowdown in the economy. In terms of some economic indicators, manufacturing contracted in 2019, so there was some signs of a slowdown in the manufacturing indexes as well as in corporate earnings. There was discussion of an earnings recession. And then in terms of economic policy, there were plenty of headlines, including the U.S. and China trade wars, the Brexit discussions in England trying to separate itself from the EU, and then, of course, here at home, the impeachment discussion in Washington. But what actually happened in 2019? None of these negative scenarios played out and affected markets. We actually saw 35 record highs in 2019. Asset classes across the globe produced double-digit returns for the most part. Both stocks and bonds had impressive years. There was actually below-average volatility in 2019, and we saw interest rates fall, not rise, as a lot of the fears showed. If you look at the actual data, you look at 2019 compared to 2018, here on this slide, the blue lines are the returns for various asset classes. You can see they're all on the positive side, some very nicely positive. And this contrasts with 2018 when both stocks and bonds actually had a down year, which is actually pretty rare in terms of markets. In fact, we hadn't seen a year like that since 1991. But thankfully, the gains we saw in 2019 more than offset the losses that we saw in 2018, and investors that were able to stay the course and stay invested benefit. I'll share some insight now into how we seek to systematically identify the environment. We found that different regimes or different environments have different implications for asset class returns and risk to investors. So we try to identify where we are now, and then furthermore, we try to identify where things could change, both on the positive side or on the negative side. So we start with a base case scenario, and this is all the best data that we have. And currently, we see an environment that calls for moderate growth expectations, low inflation, and some volatility driven in part by political uncertainty. There's a lot of variations out there, and there's a lot of scenarios that could play out. On the positive side, in more optimistic scenarios, I'll call it a Goldilocks scenario, we could see both the economy and corporate earnings accelerate on the positive side. And this could occur without impacting inflation, so inflation could stay low. This would be a very optimistic scenario and could lead to nice higher returns again in 2020 for markets and for investors. There's also some negative scenarios where there's some downside risk that we need to be aware of. And in this scenario, what if the economy slows? What if earnings growth slows and contracts? What if inflation spikes higher? What if credit contracts? These are all scenarios that are possible. We don't think they're likely, but they're possible, and so therefore it factors into our decision making. The key with this is to, again, to identify the different environments, the different regimes, and try to construct portfolios for our clients that weather a wide range of scenarios, both the base case, which is what we would say is the highest probability outcome, but we also want to consider other less likely scenarios that are still possible. And we design portfolios to help clients achieve their goals no matter what markets throw at us. So I'll cover some of the highlights of the base case scenario. In terms of the economy, we're seeing stable economic growth, and we think 2 to 3% GDP growth is expected in 2020. The consumer is very strong. This is driven in part by low unemployment and rising real wages. That's an important reason why we believe the economy should continue chugging along on the upside. And yet with that growth, inflation remains low. It's right around 2% presently. There is some chatter, there is some choppiness that should go along with the political noise and politics here in the U.S., the impeachment trial and the elections. That creates a wide range of political outcomes that will have some impact on the economy. We just can't define it ahead of time exactly how that will play out. But that to us means uncertainty and some volatility. In terms of the bond markets, 2019 was a great year for bonds. Interest rates fell, and that helped drive bond prices higher. We don't believe that's a likely scenario in 2020. We don't believe bond investors can count on additional capital appreciation in 2020. The U.S. Federal Reserve is on hold. We don't expect interest rates to be cut. We don't expect them to be hiked either. So therefore, we think yields are probably going to remain pretty close to where they are now, and they're low, but we think they're going to stay stable. That creates some challenges for investors who are looking for yield. Higher yield often means higher risk, so you have to take that into account and be careful about exactly where you reach for yield. Other concerns on the bond markets have to do with rising corporate leverage. That's something we have our eye on. But the overlying factor for us on the bond side is that bonds are a very effective tool for managing risk and for helping offset the risk of stocks in your portfolio. So therefore, bonds play a good role in portfolio construction. On the stock side, we favor equities for long-term investors. That's still the place to be. We still think there's plenty of upside for investors over the long term. The key to growth from here, we believe, is going to be earnings. Valuations are getting a little bit stretched. They're not cheap. So therefore, it's going to be harder for stocks to move up unless corporate earnings move up accordingly. And we think that's certainly possible, but again, earnings are key to growth from here. That creates an expectation for us of moderate returns for stock investors, maybe mid-single-digit returns over the next 3 to 5 years. So that's a little lower than what we've seen recently, maybe a little bit disappointing for some, but it's still positive, and it's still a good place to be for investors looking for growth. We do think volatility is going to be an issue. We're late in the business cycle. There continues to be trade-related headlines between the U.S. and China, and it's an election year. So all these things factor in and make us conclude that you could expect some choppiness from stock markets. So that being said, I just defined a scenario where bond yields are kind of low, stock returns are going to be positive but not very exciting. So why not move to the sidelines? Why not just sit in cash and wait for a pullback? On the face of it, that sounds like a good scenario and maybe a good strategy, but we would beg to differ. There's still room for stocks to appreciate. The fundamental environment is supportive for risk assets like stocks. So if you want growth, if you want appreciation, you need to be invested in stocks. Another important point is that market valuations can remain elevated for a long period of time. Just because the price to earnings ratio of the stock market is getting high does not mean it's due to crash imminently. Valuations, while they're a little bit high, they're certainly not excessive, and the market can stay in this range for quite a long period of time. It has in the past, and it could again in the future. The other side of going to the sidelines is that what can you expect to return from cash? And today, not much. In fact, if you account for inflation, you'd actually be earning negative returns from your cash. So there's a big opportunity cost to sitting on the sidelines. So to sum up, we don't think moving to cash is a great idea. However, preparing for volatility, thinking about risk going forward, and perhaps exploring a lower risk approach that still keeps you invested, that still keeps you in the market scenario, but does so with a little bit more downside protection might be appropriate for you. So I'd encourage you to talk to your financial advisor about that. We have a number of scenarios and a number of strategies that might help you with that. So here's a quick chart. I just referenced how returns from cash are low. This is a slide that shows historically what you can expect to return from cash with $100,000 in a savings account. And you'll see in 2019, it was just about $2,000 from a cash investment account. And if you were in savings accounts, it was only $600. So that's certainly not a lot to live on, not a lot of growth. And you can see by the blue line, the returns you earned in cash actually came in below the inflation rate. So not an attractive place to be in terms of cash. Another common question we hear related to risk is recession. When is a recession coming? Should we be concerned about recession? Thankfully, I'll say that we don't believe the odds of recession in this year are very high. And in part, I'll reference a recession risk indicator from Goldman Sachs. It quantifies the odds of recession this year at 19%. And if you compare this to that same indicator over time, the historical average was 23%. So what that's telling us is that the odds of recession are lower than average, even though it might not seem that way if you listen to the media. Odds of recession are actually pretty low. And some of that has to do with the factors that we just discussed. Inflation is low. We're seeing easy financial conditions. There's a de-escalation in the trade war. The consumer is very strong, and we just don't see signs of financial imbalances like you would typically ahead of recession. So we're pretty encouraged by that. It's something we're watching going forward, but in the near term, odds of recession are low. I'll wrap this up with some key points and summarize. We see a positive environment, but returns are probably going to be a little lower than we've seen in the recent past. This is driven by the fact that valuations are starting to get a little stretched, a little high, and yields are low on the bond side. So again, positive but modest returns from here are what we can expect. This has some implications for investors and for asset allocation. We're pro-risk. We think you need to own stocks. That's where the growth is going to come. But we also believe it's very important to take a balanced approach to risk management. We don't think now is the time to stick your neck out on the risk side. We think it's important to be more balanced, to have some safer assets in your portfolio to help offset some of the more aggressive assets. And that's the way we think you can achieve your financial goals. And lastly, part of any environment that's going to be key, but especially in today's environment, we think patience and discipline are key for achieving your financial goals. It's important that you rely on an advisor like Signet to help you to stay disciplined and to be patient and and keep you on course. So I want to thank you for your time and continued trust. If you have any questions or want to discuss your portfolio, I'm always available. You also have your financial advisors here with us. And you can also follow us on Twitter at SignetFin. There's a lot of great commentary that we publish there, and you might find some more insights there. Thank you for your time.